You check your investment app during your lunch break, and suddenly, everything is red. The numbers keep falling, your portfolio is losing value, and for a brief moment, it feels as if your money is simply disappearing. Your first instinct might be to sell everything before things get even worse. But what is actually happening behind those falling numbers is far more interesting than most people realize. A stock market crash does not mean that billions of dollars suddenly vanish into thin air. It feels that way because the numbers on your screen change so quickly, but the reality is much more complex. A crash is really a reflection of how millions of investors suddenly change their expectations about the future. And understanding that difference completely changes the way you see your investments. When you buy a stock, you are purchasing a small ownership stake in a real business. Whether that company makes smartphones, builds cars, sells coffee, or develops life-saving medicine, you become one of its many owners. The value you see on your screen is simply the latest price that investors are willing to pay for that ownership, and that price is constantly changing as new information reaches the market. The important thing to understand is that the stock market does not only measure what companies are worth today, it also reflects what investors believe those companies will be worth tomorrow, next year, and even 10 years from now. That is why prices can move dramatically, even when nothing inside the business has changed overnight. Imagine that a company reports excellent profits, but investors become worried that sales could slow down in the future. Even though the factories are still operating, employees continue working, and customers keep buying products, the stock price can still fall because expectations have changed. The business remains the same, but confidence in its future becomes weaker. Now imagine that this happens to thousands of companies at the same time. News about rising inflation, higher interest rates, political uncertainty, or a possible recession begins to dominate the headlines. Investors become nervous. Some decide to sell, others see prices falling and panic as well. And before long, the selling feeds on itself. What started as concern quickly turns into fear, and fear spreads through financial markets much faster than optimism ever does. Psychology plays a much bigger role than most people expect. Nobel Prize-winning psychologist Daniel Kahneman demonstrated that people experience the pain of losing money much more intensely than the satisfaction of making the same amount. This principle, known as loss aversion, explains why investors often make emotional decisions during market crashes instead of rational ones. Once fear takes over, many people stop asking what a company is actually worth and start asking only one question: how much lower could this go? That shift in thinking creates a powerful chain reaction. More people sell, prices fall even further, and the headlines become even more alarming, encouraging even more investors to leave the market. So where does your money actually go? This is one of the biggest misconceptions about investing. In many cases, the money does not actually go anywhere. If a stock falls from $100 to $70, it simply means that the market currently values that ownership lower than it did before. Unless you sell your shares, you still own exactly the same portion of the company that you owned yesterday. Think about owning a house. If houses in your neighborhood suddenly become less expensive because of changing market conditions, your home's estimated value may also fall. However, the house itself has not disappeared. The walls are still standing, the roof is still there, and the property has not changed overnight. Only the market's opinion of its value has changed. Stocks behave in a very similar way. History gives us many examples of this pattern. During the financial crisis of 2008, global markets lost trillions of dollars in value as fear spread around the world. Many people believed the financial system would never fully recover. Yet over the following years, businesses adapted, economies stabilized, and stock markets eventually reached entirely new record highs. The same thing happened during the COVID-19 crash in 2020. Markets experienced one of the fastest declines in modern history, creating panic across the globe. Investors feared the worst, but companies adjusted, governments introduced economic support, vaccines were developed, and markets recovered far sooner than many experts expected. Of course, not every company survives every crisis. Some businesses fail, some industries shrink, and some investments never recover. That is exactly why diversification is so important. Instead of relying on a single company, many long-term investors spread their money across hundreds or even thousands of businesses through broad index funds. This approach reduces risk while allowing them to benefit from the long-term growth of the global economy. Economist Eugene Fama, whose research transformed modern investing, showed that consistently predicting short-term market movements is extremely difficult. Countless professional investors attempt to buy at the perfect moment and sell before every downturn, yet very few succeed over long periods. Trying to time the market often leads to buying after prices have already risen and selling after they've already fallen. That is why experienced investors usually focus less on investing tomorrow and more on preparing for the next 10 or 20 years. They understand that market crashes are not unusual events, but natural parts of the economic cycle. Every recovery in history has followed a period of uncertainty, and every period of uncertainty has eventually come to an end. The next time you open your investment app and see a sea or red, remember that the screen is showing today's emotions, not necessarily tomorrow's reality. Markets move because people react to news, expectations, and uncertainty, but businesses continue to innovate, workers continue to create value, and economies continue to evolve. Instead of asking where your money is gone, ask yourself whether the businesses you invested in still have the ability to create value over the years ahead. That simple change in perspective separates emotional investing from disciplined investing. A stock market crash can feel frightening in the moment, but once you understand what is really happening beneath the surface, the red numbers stop looking like the end of the story. They become just one chapter in a much longer journey, reminding you that while prices may change every day, long-term value is built over time, not overnight.